Good morning, everybody. Thank you for coming to our latest webinar. My name is Rakesh Murria. I'm the COO at Ascension. We are an early stage technology investor and have been doing this since 2015. Today's webinar is entitled Pulling All the Levers. This is a set of ideas. And the way I would describe it is everyone had the hot takes from the budget on the day of the budget. Now, a bit later in the cold light of day, there was actually quite a lot of substance in the budget. Quite a lot of impact, particularly around things like inheritance planning and tax planning and pensions and all these things. And so today we'd like to talk about a small bit about Ascension, and then a big sort of the meat of it is going to be about some ideas for you to think about how EIS can work in the armory of things you have for planning for your clients. Normally, I don't sit here and go through the disclaimer. I'm going to let you read it, but the point I'm going to say is this really is for financial intermediaries only. I have the luxury of being the COO, so I'm also the compliance person, and that will mean I'm going to double down on my disclaimer today. You'll get this disclaimer and another one in a minute. I'll talk to you about that when we get there. As I said, Ascension is an early stage technology investor. We've been supporting startups since 2015. We've got 100 million AUM, over 150 portfolio businesses that we've invested in, and 14 profitable exits that we've had in that time, with our first exit being at the end of 2019. We run a number of funds. We actually run a set of institutional funds as well. Ascension is both a tax-efficient investor and an institutional investor, which we think is great coverage in terms of the kinds of deals that we see. Our funds range from our S fund, which was the first fund we ever launched back in 2015. We have our EIS and knowledge intensive fund, SEIS, EIS and KO, all invest on the same thesis over a different time span in terms of pre-series A to late seed. We have our Fair by Design EIS, which co-invests with our institutional fund, and our carryback EIS, which is a specific fund designed for rapid deployment. I'm not going to go into that too much now, but there'll be a little bit about it at the end for those that want to learn about it. So the first thing I'm going to do to recap before I go into sort of, as I said, the meat of the areas I'm going to talk about is the benefits of SEIS and EIS themselves. Apologies if this is teaching people to suck eggs, but you're sort of getting the groundwork done in terms of starting. So I'll start with SEIS in terms of what the benefits are. So with SEIS, it's an extremely attractive tax regime because you're investing at the earliest stage for these businesses. Generally, an SEIS check will be one of the first checks that a company receives if they're getting investment. And with that comes 50% income tax relief, up to 14% of CGT reinvestment relief as well. This is why you only end up paying 13.5% of your investment at risk. And there's also up to 22.5% loss relief. So if all the businesses failed, there's a loss relief available. And hold those shares for 3 years. Any realizations that you have are free of income tax or capital gains on realizations. And where this is particularly important, as we're going to talk about this asset class of SEIS and EIS, same for both, is that the first £1 million of these assets that are held is 100%, you get 100% inheritance tax relief on them, provided they've been held for a couple of years. And then a way of supercharging all this, which I'm going to go into in this presentation, so I won't go into it too much now, is the use of business investment relief for qualifying non-dom investors. So as you can see here, the first thing that I'll talk to you about is this idea that when it comes to SEIS, which we've got about £900,000 available at the moment for next year's fund, with the CGT relief as well, it's an extremely attractive tax regime with only 13.5% of your capital at risk. Going to move into EIS now. So again, talking about the benefits here are using the numbers of being a top rate taxpayer. And the way I'm building this up to give you the example is, what is the worst case scenario? If it all fails, what happens? And that's what these numbers are. So in the worst case for a top rate taxpayer, you're putting 38.5% of your capital at risk, plus you're also getting 100% CGT deferral. And I'll talk to you about that in a second. So income tax relief, there's 30% income tax relief on EIS. You can also invest significantly more in EIS than you can in SEIS. Those tax reliefs are very attractive for SEIS, but it's a 200k limit. With EIS, you can do up to £2 million in any year, $1 million of standard EIS and $1 million of knowledge intensive EIS to hit that full 2 million amount. You can also get loss relief on those investments up to 31.5%. So if those entire investments failed, you can see the 30 and the 31.5 gives you an idea of what's been put at risk. And then on top of that, there is CGT deferral. The eagle-eyed amongst you will have noticed that the top-rated CGT changed to 24%. So why have I got 28% written here? There is a class of individual who's paid something called carried interest. if you're paid in carried interest, that is taxed as a capital gain, and that is currently taxed at the 28% tax rate, and that is actually going to go up to 32% in April. So the examples I'll give you later are really going to be based on the 24% CGT rate, but in terms of what the maximum reliefs that you can get are, depending on investors and their circumstances, that's the number. And then again, the capital gains exemption on realizations as long as they're held for 3 years. So that is what I would describe as, what am I putting at risk? What's the worst case in a failure scenario with the tax reliefs available? And then what I've done here is take it the next level up, right? So what do I have to believe as an investor to get my money back? So not that I'm putting a certain amount of capital at risk, but what do I have to believe to actually get my money back? And to do this, I've used Ascension's actual fee structure for a £100,000 investor. I've done £100,000 because it's just much easier for me to do the maths. In this example, we have a 5% upfront initial. That's the only fee we take. I know other funds will have a small initial, but then they hold back management fees, etc., for the investment. We just take a 5%. And one of the things that we actually offer is you can just pay your investment fee separately. So when it comes to planning EIS, sometimes it can get very complicated that you're kind of having to gross up the amount that you're looking to invest to get the tax relief that you're looking for. This is just to make that easier. We just say, tell us the amount that you want invested, and then we'll tell you what the fee would be separately. In this example of 10 investments, which is the portfolio we build for you, 5.5 times return will give you a profit effectively. So one investment of £10,000, £3,000 tax relief gives you a £55,000 return, including your initial investment. All the other investments fail. So £90,000 invested, £27,000 of income tax relief, £28,000 of loss relief. And then I've assumed that this happened over a 5-year time horizon. So we held those shares for 5 years before it exited. I've included a 1% management fee at the end of all that. And putting that all in together, you can see here that that £100,000 investor, including the fees that they paid, has been returned £102,000 back. So we started with what's the worst case, and it's like, what do I need to believe to get into that record? And then to take that a step further, what has the real world looked like for Ascension so far? So here you can see a chart that has this center line here is 1x. So, the value of investment at cost. The green line is the gross realized value of those investments in the funds. And the blue line is the value of the unrealized assets. The valuations for uplifts are externally based. So if there's a follow-on round, we can't lead it. Somebody else has to price that round. And again, you can see here that across a number of these funds, a lot of the funds, we've started returning significant amounts of cash back to the investor. It's very easy to get hung up on tax reliefs at this time of year. But if you add in the tax reliefs to that track record, you can see how a number of investors are well into the black. And we've also got another set of investors extremely close to where we're at. And for those that think about impact, Ascension has been recognized as an impact investor. I think we've proven for a long time now that we can do tech for good impact investing and commercial investing as we do here and get the same kind of returns. You'll see here the first 2 years of our Fair by Design institutional fund has almost already fully returned its money back to investors. Right, let's get into the meat of it. You can see I've built a beautiful AI generated image of pulling the levers. So let's get set. First thing I'm going to do is give you my second disclaimer that I promised you earlier on today. This is a set of illustrative ideas to help advisors consider options for their clients, right? Only some of these might be as applicable to you or suitable for you. Maybe none of them are going to be applicable or suitable. And it's really about individual circumstances for tax planning. The idea is that this is supposed to be part of a balanced portfolio, one of a set of ingredients for when it comes to financial planning. What we're talking about here is what you do for a living, I know, but balancing the benefits of this kind of investing for the income tax relief, CGT relief, CGT deferral, IHT relief in terms of what comes, the pros of that with the cons of what's the risk appetite, how much illiquidity am I willing to have, as a client, and kind of putting those two things together to build the right portfolio for your clients. So the first thing we're going to talk about is addressing the pension changes that have happened with taxation. So from April 27, unused pension funds and death benefits will lose their IHT free status, right? So one of the things that, sure you've had, and I know a number of people where they've effectively put a pension pot aside from their own pension pot that they're expecting to give to their children. And now that is going to be it's always been subject to income tax, but it's now going to be subject to IHT as well. And so what that could mean is take a pension pot, you take 40% inheritance tax off that, and then as it's drawn down, you pay income tax on it. So if the person that you're inheriting is a top rate taxpayer as well, potentially, that's a marginal tax rate of 67% on that income, right? So you had £100,000, let's say, 40% went away straight away, and then that £60,000, there was 45% tax. This is, we think it's a significant challenge, and it's going to involve a lot of strategic planning. EIS can really help mitigate this. And basically, the idea is that you take some of a pension pot, draw that down now, take advantage of the tax rates you get for doing that, and investing some of that into the EIS scheme to get income tax relief, and put it into the, that £1 million number that we talked about in terms of being IHT free as well. The key insights that I'm going to give you here, I'm going to give you a better description of this in a second, hopefully. But we think there's significant tax savings in terms of by investing in the EIS that you'll be able to move things out of the IHT bucket. This is for growth kind of investing that we're doing. We're going to give you some more flexibility about what you do. The things to think about are tax variability, income tax rates, other things may change in the future. And of course, I'm looking at this as an example in its isolation. So you can see here, I've got some numbers which are based on saying, let's say this was the only income that you had and you drew down. I've included personal allowances and things. The reason I've done that is to try to make it standalone. But obviously, there are other income sources that your investors are going to have. Hopefully, you'll see, irrespective of whether I'm including my allowances and paying different rates of tax, this is an interesting thing to look at. Getting into that, you can see here that we've got quite a complex looking chart, but hopefully fairly straightforward to explain. The example we've taken here is a £500,000 pension pot being drawn down over 5 years. No other income, just to make it easier to do the maths. Why is that income being drawn down over 5 years? I was on a podcast yesterday with Hardman & Co. talking about this very subject, about the ideas of what to do with the budget and the EIS and BCT and how that works. And one of the things that I think is really important when it comes to this kind of investing is that you do EIS investments over time. So you build your portfolio in two ways. You diversify across fund managers that you work with, and you do it over time. The great phrase that Brian had during this was temporal diversification, by not putting all your eggs in one basket, using multiple fund managers, and not being subject to the whims of what happened in one particular year and spread over a broader economic cycle, which may be, a bubble or something else that you didn't realize by investing everything. So what we've done here, the first thing is taking the tax-free lump sum. A quarter of the investment pot, pension pot, can be done to a specific limit, your lifetime allowance, drawing that down as £125,000 of tax-free income. And then the next part is the 5-year drawdown of £75,000 a year to get to your £500,000 pension pot. The £87,160 is the income tax that you would pay on that drawdown, as an example. Of that $75,000 a year that you were drawing down, you've put $50,000 a year into EIS. We're not saying put every single penny out of your pension into EIS in this example. I'm just trying to give you a worked example that you can sort of work with. So you've got this $250,000 going out, and what's come back to you is £75,000 of EIS relief, 30% of that investment. So hopefully that all makes sense so far. By doing this, that £500,000 pension pot that you were just going to hand down previously would have been subject to £200,000 of inheritance tax. You're taking your tax-free sum, you're drawing it down as income, and you're investing it. Those assets, well below the £1 million value, can be handed down as part of inheritance on a tax-free basis. So you've completely mitigated this £200,000 tax bill that your beneficiaries would have paid. If you then look at that, take that $500,000 you've done, take the tax that you've paid, take the EIS money that you've invested, and the relief you got back, and the IHT you've mitigated, you will have got yourself to the point that you've basically put £62,000 of that £500,000 at risk before any of these investments pay back. So your net position here is, sort of 438,000-ish. You can see your net position before you get returns. So just on the tax treatment. And then let's assume that you get a 1x return on your money. Then we're talking about, that £500,000 is suddenly 687,000. A 2x return, suddenly 937,000, and the 3x return that we target for our investors, you're looking at about 1.2 million. So you can see here from a tax planning and a kind of risk perspective, obviously you have to think about the liquidity and other things that you're willing to accept in terms of what you're handing down, but you can see there's a very attractive potential offering to look into. I understand that this is fairly technical, so we will be making these slides available. And again, as I said, we're recording this, and so you can go back to any point of reviewing. Well, that was quite a meaty one. I would say, lots to talk about in there. Definitely something that I've seen, as I've been talking to advisors and people in general. The next one that people are certainly talking about is whether or not to transfer from the AIM market to the EIS market. Why would we do that, by the way? So from April, AIM shares were going to see a big change in their inheritance tax treatment. Before, they were subject to 100% business property relief after 2 years. Now they're only going to get 50% business property relief, which will mean an inheritance tax rate of 20%. An AIM shareholding of £1 million used to be tax-free in terms of it being inheritable. It's now going to be £200,000 on a million. My example is really straightforward, right? It comes back to the scales that I described, which is basically saying if you've got AIM portfolios, I'm not really going to get into the performance of AIM. I appreciate that there's been a lot of volatility in it. I'm just talking about how EIS can help you. You can shift these investments from AIM to EIS. One of the most interesting things is if you actually look at the legislation is not written yet, but as it stands, business property relief, replacement relief would also mean that the 2-year waiting period that you had when you did your AIM investment is eliminated, but we're waiting for complete clarity on that. But that would also mean that the clock does not start ticking again. That's the phrase that people use. You've got significant IHT savings. You actually get to take that income from liquidating your AIM portfolio. It immediately turns back into income tax relief. If you were having gains that you realize from that, you can also defer the CGT. The thing I didn't talk about earlier when I went into EIS and CGT deferral is for estate planning, super important to know the gain dies with the investor. So if it's in EIS and the gain's been deferred, when it comes to estate planning purposes, your investor passes away, the tax bill goes along with it. The thing you need to think about here is really simple. How much liquidity do I want? Early stage EIS is probably more inherently a higher risk investment. Let's look at £1 million holding in AIM for an investor. What would happen if I decided to shift across to EIS? And I've done it here by going in 20% increments, 1/5 increments. If I did nothing, I'm going to pay £200,000 in IHT. If I did all of it, I'm not going to pay any at all. But you can see here, I'm getting this relief back as well, right? So 60,000 at 20%, 300,000 at 100% on this £1 million holding. So if you wanted to completely net out the tax implication, you're looking somewhere between 60 and 80% shifting across. But where does your view on liquidity stand is the important point to make there. Hopefully that's fairly straightforward. This table is just trying to give you the illustration, but it's worth looking at transferring from AIM to EIS as part of a balanced portfolio in terms of what you do. Right, I'm going to now talk about the other point I raised earlier. For those of you that spotted that 28% CGT rate, this is about mitigating CGT on carried interest. So who earns carried interest? Fund managers, private equity individuals. A lot of people can have that as a significant source of their income. It's quite a highly exclusive group, about 7,000 people. But if you know them, it's definitely worth making sure that they understand the benefits of what's available via EIS for this. Their tax rate is going to go from 28 to 32%. I had a great conversation with Nimesh Shah at Blick Rothenberg, who I ran these ideas past originally, just to make sure that, wasn't smoking my socks when it came to these ideas. There is some ambiguity in the legislation. It's not 100% clear if they will be able to defer the full 28 and 32, or if they'll defer 24% of CGT if they do this investment. And it's still being discussed in tax circles. So, if you have a view on it, it'd be great to hear it. So I said there's not many people, but they earned 5 billion in income in 21-22 and they paid 1.4 billion in tax. There's a significant amount of tax and help you can give these individuals if you're working on a wealth management basis with them. So the idea here is very simple. You invest in EIS or SEIS to either write off or defer that investment. A thing to remember is that these people are earning a significant amount of income outside of their position, so they will be top rate taxpayers by default. You can do the £200,000 of SEIS, you can get £32,000 of CGT relief plus £100,000 of income tax relief. As an investor, you can also get the 30% income tax relief and up to £640,000 of CGT deferral. So hopefully that's fairly straightforward, sort of simplistic, but to give you an idea of interesting areas that you might be able to look at for certain clients. And now finally, just going to touch on leveraging business investment relief to supercharge investments. This is available for non-UK resident, non-domiciled individuals. It's going away in 2028, but it's a super interesting way of supercharging returns for investors. We've had a number of individuals here with us that do this as an investment. So what happens is that basically, if you have offshore cash income, you can bring it onshore. And so long as it's invested within 45 days of bringing it onshore, you do not pay income tax on it. And when you don't pay income tax on it, you can also get the EIS benefits on top, which is fairly crazy, right? So you've got the one benefit of you invested it. And then the second benefit is you can then get on your UK income, the capital gains deferral, the income tax relief, all of those things too. So the example I've taken here, a £1 million investor who would have paid £450,000 in tax. They invested the rest in EIS and got £165,000 of tax relief. That 550 gets 3x and they got their 165. So they ended up with a net position of about earning £1.8 million. Fantastic, amazing, brilliant. Imagine that they didn't pay, imagine they did exactly the same investment, but instead of putting 550,000 in, they were able to put the full million in because they didn't pay income tax. That million gets 300,000 of relief. It gets 3x. That 1 million became 3.3 instead of 1.8. So again, for those clients that have it, it's super interesting. Ascension offers the offshore banking facility to do that. The money is invested over time still. It's just held in an offshore account to do it. Thanks ever so much. We've got our SEIS fund open. It's got an April 3rd close. There's about £900,000 of pure SEIS left. We expect that to be fully subscribed ahead of April. So if you are interested, please get in touch. If you've got clients interested in SEIS with the CGT write-off, I think it's super valuable to look at right now. Our Ascension EIS and KI fund. So our KI fund is open and will close on April the 3rd. It needs to be fully subscribed by April the 3rd for its investment. The standard EIS has a rapid deployment option, which is our little logo here. If you invest by the 25th of January, you can have deployment in about 4 companies for this tax year. And the particular importance about that is that both of these ideas, whether you do KI or whether you do rapid deployment, allow you to carry back into the previous tax year. You get 11 businesses in the KI, by the way. Our Fair by Design EIS, its next close is April 3rd for 25-26, which, as I said, co-invests with the themes from our institutional fund, including our latest Ascension Fund 3, which is a £50 million fund, which has had its first 20 million close. And then finally, if you're really looking for rapid deployment now, we have the Ascension Carryback EIS. It does what it says on the tin. 25th of January for deployment in 8 companies between now and the end of the tax year. 25th of February for deployment in 4 companies before now and the end of the tax year. I hope that was useful to you. Bill, Ben, myself, we're available and we'll reach out to you after this to follow up on the session. I hope you have a good day and look forward to speaking to you soon.